I saw this tweet the other day. What is the most undervalued stock in the market today? If I give you an answer right now, are you going to invest all your money into that stock? Probably not. And today we are going to talk about the different answers, the most popular answers given as a reply to this tweet. Also my answer, which I will tell you in a few minutes. But first we have to understand the logic behind this question and also the logic behind the proper answer to this question. If we are talking about the most undervalued stock in the market right now today, it means we understand that stocks, companies, they have an intrinsic value, and then we have the price, the market capitalization. So the most undervalued one means the one that is trading at the biggest discount from the intrinsic value. So the market cap, let's say, is $100 million, while the intrinsic value is $1 billion. So we are trading at a 90% discount. This is not a hard task for me to do because I have hundreds of companies I have looked at. I have calculated their intrinsic value. I have a spreadsheet where I put everything there. So it's easy for me just to look at what is the most undervalued there. And if you look at the spreadsheet, and by the way, this spreadsheet is available on the Superinvestors Club. If you want to join, you will have access to all my investments, all my research, all my analyses. You can try it for free if you're interested. There are also courses, investing for beginners, more courses I'm working on. So let's get back to this spreadsheet. If we look at this, it seems that one of the most undervalued one which I looked at recently would be Ferexpo, which is at an 88% discount today. It means if let's say you invest $10,000 in Ferexpo and you're right that the intrinsic value is eventually reached, that $10,000 will go to over $80,000. It looks like the best possible investment in the market right now. But you have to understand something about this company Ferexpo. It is undervalued if you're using discounted cash flows, you're using liquidation value, all the methods you can use to calculate the intrinsic value of a company. You use everything on Ferexpo, it will look undervalued. So why is the price so low? It's because it is a Ukrainian company. And we know that there is a war in Ukraine. We don't know where this war is going, where it is going to end, how it is going to end. We don't know anything about that. So you can invest your $10,000 in Ferexpo, but if let's say something very bad happens, it can go to zero immediately. So the risk with this company is quite big. It's not just the risk with the stock, it's the risk with the company itself. It's quite big. It's not just about investing in the most undervalued stock. Because when you're calculating the most undervalued stock, you're using discounted cash flows. You're not looking at the worst case scenario. The worst case scenario here is zero. And most companies, there is a possibility that they go to zero. But a really good company, that won't happen. Apple will not go bankrupt anytime soon. Google will not go bankrupt anytime soon. You can be sure about that. But a company like Ferexpo, it can go bankrupt. When I invested in GameStop in 2019, I knew that there was a chance it goes bankrupt, but the risk-reward asymmetry was so big that I was willing to put a lot of money on GameStop. And today this has changed. Now GameStop is overvalued. I'm not going to touch it again. So this is how you need to think as an investor. What is the maximum amount of money you're willing to lose? And this is the investment. So it's not just about being undervalued. And I prefer looking at the bad cases. What happens if, let's say, not going bankrupt, but there is something bad happening to the company. If the stock price is down, it is because something bad is happening to the company. If this continues, if this gets worse, am I willing to hold the stock? I prefer to be positively surprised in the market instead of having some negative surprises where I lose money. I prefer to make money that I wasn't expecting. So if we are looking at certainty, there are two stocks, and these are the two famous one people answered on this tweet. It's Google and UnitedHealth. We can be sure that Google is not going to zero as we talk about, but is it really that undervalued? If you're looking at, let's say, Apple in 2016, which was trading at 10 times earnings. We look at Meta in 2022, trading at, I think, 15 times earnings. These were really undervalued companies, which is not the case with Google today. It is trading at around 20 times earnings. And if we look at free cash flow, 24 times free cash flow, which is not something I will call the most undervalued stock in the market. Yes, maybe it is undervalued, which I won't say it is. I will say it is fairly valued according to me, but it is not the most undervalued. What about UNH? I cannot give you an answer with UNH because it is outside my circle of competence. I prefer not investing in companies where the government can come and just change the laws and everything changes with the company. It is outside my circle of competence. I won't touch it. What is the intrinsic value? I have no idea. So I cannot correlate the most undervalued stock in the market today. Probably it is, but I don't know. I'm not that smart. So the answer that I gave is not Crocs, which is one of my largest positions. It's not Wise, my largest position. It's not Booking Holdings, a company I love a lot. It's none of the stocks in my portfolio right now because there is no correct answer to this question. If let's say I say Crocs, I can correlate the most undervalued one. But what's the vision with Crocs? That it is going to reach its intrinsic value, let's say 2-3 years. I take profit. And then what? Now, if let's say I'm thinking about the next 20 years, I would rather invest in a company like Booking Holdings because I believe that in 20 years, more people will be traveling. The company would be generating a lot of cash, buying back a lot of shares, which makes a great investment. This is not really the case with Crocs. With Crocs, I'm willing to invest 2-3 years. If let's say the fundamentals are still here after 3 years, I will keep investing. It depends because this is fashion. With fashion, trends change over time. So you have to be careful. But with Booking Holdings, I know in 20 years, probably it's still going to be the leader. Now, if I'm willing to take a little more risk, invest in something that has a moat, but is increasing the moat, is growing very rapidly, is changing the way we do things, I will rather go with Wise. So there is no single answer to what is the most undervalued stock in the market today. And this is the answer I gave. It depends on who you are asking. Because to calculate the intrinsic value, even if let's say you don't want to consider risk reward, you just want to look at what's most undervalued, you calculate discounted cash flows, it is subjective. There is no common answer that everyone will give to what is the expected cash flows of a stock. And if someone like me outside the US who has to pay 30% taxes on dividends, withholding taxes, and I don't pay capital gain taxes where I live. So dividends for me is worse than capital gains, much worse compared to the normal US investor. If I take that into consideration, I'm not willing to invest that much into companies paying dividends. So the way the company rewards its shareholders also affects the intrinsic value that I have to calculate for me. The intrinsic value is not something that everyone knows. It is something that is for you, what you're looking for, your risk and reward, your opportunity cost. If you have an investment you know for sure can pay you 10% a year with high certainty, maybe that should be the discount rate you use. I don't know, maybe someone promised you, make it a contract, I'm going to pay you 10% a year every year as long as you stay invested in my business has no risk of going bankrupt. This is your opportunity cost for you. But for someone else, maybe the opportunity cost might be treasury bills. So if you're interested to know why I'm not willing to invest in Google right now, I will recommend you watch this video next. Have a nice day and goodbye.